Are you ready to explore the world of options trading? Today, we're diving into a powerful strategy: selling credit spreads. A credit spread involves selling one option and buying another of the same class, with the same expiration but at a different strike price. It's a strategy designed to minimize risk and maximize potential returns. Let's break it down. Picture yourself selling a call option at a lower strike price while buying another call option at a higher strike price, both with the same expiration date. This formation is known as a bear call spread. Alternatively, you can sell a put option at a higher strike price and buy another put at a lower strike price, also with the same expiration date, creating a... Why consider selling credit spreads? First, it limits your potential loss. Even if the market turns against you, your loss is capped by the spread between the strike prices minus the premium received. Timing is crucial. Selecting options that are about to expire can be advantageous, as time decay works in your favor, eroding the option's value over time. This increases the likelihood of profiting from the premium. Additionally, understanding market conditions is vital. Analyzing trends, economic events, and volatility can guide your strategy, helping forecast price movements accurately. Moreover, maintaining a diversified portfolio reduces exposure to undue risk, increasing your resilience amid market fluctuations. Always remember the importance of discipline and consistent risk management. Setting realistic profit targets, using stop-loss orders, and thoroughly understanding the mechanics of options trading are key components of successful credit spread trading. In conclusion, selling credit spreads can be an effective strategy, balancing risk and reward. While it's a sophisticated approach, with adequate research and practice, you can navigate this exciting terrain confidently. Commit to ongoing learning and sharpen your skills. The world of options trading awaits.